Okay, let's look at two common terms which are generally used and which have a very key usage. One is the deferred tax. See, the reason why the deferred tax comes into picture always is there are two worlds of tax. One is a tax that gets created from your financial statements, a profit made, and on that some tax. Generally, the tax rate is your corporate tax, right? And today we see this is again on a slab basis. This corporate tax is always on a slab basis, just like our income tax. Probably for the first some amount, we don't have any tax. So from this to this, the slab is next one, and from the next, you go into a higher slab. That's the typical way the tax structure always is. So the same thing holds in case of a corporate tax. Any profit that the company is generating. So today it's like 30% plus. So the 30% plus 3% surcharge and education cess. So 2% on that. So finally it works out to 33.333 or 34. Okay, 33.33 or 33 and 2%. Yeah, probably 33.6 or close to 34%. So that is what is typically levied on the profits. But that would be levied in a slab orientation. So if you just try to compute the total tax the company is paying vis-a-vis the profit, it may not be exactly 34%. Because there are some ways in which the company can save some form of a tax. And probably it will end up the net wise, if we see in this case, they have paid a tax of 784, or the tax amount is 784 on a profit of 3469. So probably if I just try to compute the percentage, 784 divided by 3469, it was working only to 22.6%. Right? Because it's a slab way. Now, it does not mean that any extra, another 100 crores profit they get, they will not be levied another 22% extra. They will be levied another 34% extra. The reason being it's a marginal tax. Initially, for some initial profit, you don't have a tax. So, on an average, when we look at, the average looks like a lesser tax amount. But any extra amount profit you are generating, the tax that is levied is the extra 34% on that excess amount, not the 22%. Right? Because let's say your salary is 5 lakhs, and let's say up to 2 lakhs you don't have any tax, and on the remaining 3 lakhs you are charged at 30%, let's say. So the tax amount which you are paying is 90,000 or 9,000. No, 90,000. You are paying 90,000 as the tax. 90,000 on a salary of 5 lakhs. You are paying just around 18%. Though your tax is around 30%, because of the slabs, you are ending up paying only 18% of your total income. Whereas, let's say your salary got increased by 1 more lakh. Your tax will not just increase by 18%, it will increase much more than that. Because now you are levied on 4 lakhs at 30%. So you are paying 1,20,000 as the tax over 6 lakhs, which is making it 20%. How did I get that 20%? That excess amount, whatever is there, excess profit, I am taxing that excess profit by the complete tax rate, not by the average tax rate. Right? That's a typical taxation structure. Now, okay, where is the deferred tax coming into picture in this story? See, there is one mechanism of finding out the tax which is done by the financial reporting standards, GAAP or IFRS. They say whatever is your profit, on that profit you have to pay a tax. Fair enough. So this is the financial reporting mechanism of tax. Similarly, parallelly, there is a tax reporting mechanism, which is again, this is as per GAAP and IFRS, that is as per the tax reporting. These are two different structures. When I actually do a filing for tax, it is a completely different mechanism versus when I am filing my financial reports, when I am preparing my financial report. These two are two different activities and they have to be done separately. Now, there are a few areas where the financial reporting differs from tax reporting. The processes used as a part of financial reporting, they differ from tax reporting in a few areas. For example, depreciation, one area. What the financial reporting says is, you can do the depreciation on a straight line basis, which is equally spread. If it is 30,000, you spread 6,000 every year. That is what probably a financial reporting mechanism talks of, and almost any company you see as a part of their depreciation mechanism, they use a straight line mechanism itself in their financial statements. Whereas the tax reporting does not go with straight line depreciation. The tax reporting says you have to do your depreciation on a written down value method, which is okay. If they say the written down value is 20%, if your amount, let's say if you have bought it for 30,000, first year you are making 20% of this 30,000. So in the first year, your depreciation is 6,000. In the second year, so because 6,000 is already over, the remaining amount is 24,000. So the 20% will be applicable on 24,000. So you will pay a tax of depreciation of 4,800. So like that it changes on the remaining amount, another 20%. Like that the written down value method goes. Right? Now in this, what is happening? The depreciation amount is changing between your financial reporting format versus the tax reporting format. But at the end, I mean, if I look at the whole life of the asset, both will become zero. The whole asset has to be depreciated in this, the whole asset has to be depreciated in this. Only the year-wise allocation is different. Overall, it is the same. If I look at 5 years or 10 years as a perspective, then the amount that is depreciated is same. But year-wise, there is a difference. Right? So, even if I compute the profit computation is different between the financial reporting mode and the tax reporting mode. Because if depreciation is different, the profit will be different. Profit will be different means tax will be different. Correct? So, whatever your financial statement is reporting versus your tax statement is reporting, the tax part is different in both of them. So, it may so happen that your financial statement may say that the tax is 784. Whereas when you are doing the same income statement calculation as per the tax reporting standard, where probably the depreciation the depreciation may not be 218, but depreciation may be only 200 in that model. If the depreciation is 200 in that model, obviously your profit is higher in that model, right? Your expenses are lesser, your profit is higher, your tax will be slightly higher, right? So in this case, the tax is 784, but probably in that case, let's say the tax is 790. But what you have to really pay is the 790 itself, because it has to be paid as per the tax. The real tax payment happens as per the tax reporting framework. But this difference can reverse in future, because this year probably the depreciation is lesser compared to last year, but next year it may be more, because we are saying the asset over its life everything will be same, only year by year it will be different, right? So this difference can very well revert in future. Whenever I see that the differences can revert back in future, only year on year there is a difference, I will create a deferred tax. Because the tax wise, either I am paying more than the required or less than the required. It may so happen here, if the depreciation is 250, my profit will be lesser, the tax will be lesser. So in that case, the tax will be, let's say, 770 only. So there might be a case that I am paying less tax than what my financial statement is saying, or more tax than what my financial statement is paying, the real payment wise. But this is going to revert back. The opposite may happen next year. Whenever I am seeing that it is going to revert back, I will create a deferred tax. So if I pay more than what my financial statement is saying, then I will create it as a deferred tax asset. So because I have made like a prepayment, advanced payment. My financial statement is showing only 784, but I am paying 790. There is an advance payment of the tax I have done. So that advance payment is what I treat it as a deferred tax asset. And in some cases, it may so happen that I will pay lesser than the required. Then I treat it as a deferred tax liability. So that is different from the tax expense to the prior years. Tax expense of the prior years is the previous year's tax, which I did not pay, which I have to pay this year. Whereas when I am saying deferred tax, only if it is revertible. Only if this difference can be reverted back, then I am treating it's a temporary difference. But this comes every year, because depreciation methods are different. So every time some change will be there. Apart from depreciation, there are couple of more areas where deferred tax asset plays a important role. One, the sales returns. You have sold something, right? Generally, every company will expect that some part of the sales will come back, like your warranty expenses and all, right? Every company, they provide a warranty. As a part of the warranty, whenever the product is defective, they replace it with a new product. So generally they can reasonably assume that probably 1% or 2% of their products, depending on whatever their calculation is or their experience is, they can reasonably assume 1% or 2% of their total products will have to go through a warranty, which means they have to replace them for free. So that extra cost of the new machines will go as their expense. The financial reporting simply says, if you can reasonably expect how much will be your warranty expense, you show it as an expense in every year. If you can reasonably expect 1% of them or 2% of them will come back and I have to replace, that percentage you show it as a warranty expense every year. But the taxation world is slightly different. What it simply says is, when they really come back, then claim a benefit. See, if that 2%, your financial statement is saying, you reasonably assume it and compute your profit, then the tax. Whereas the tax world says, why that reasonable assumption and all that stuff? Take it on actuals. If 5% of the goods came back, you reduce your profit by 5% and pay a tax only on that much amount. If only 1% or half a percent come back, you pay more tax. Do it only on actuals, no assumptions, as per the tax reporting. So again, there also you end up either paying more tax or less tax. Right? Sales returns, exchanges or some returns, some defective pieces and all. You can, as a part of financial reporting, they say reasonably assume and make your profit accordingly. Whereas tax reporting does not believe in that concept. When it has occurred actually, then only claim it. No assumptions. So there is a difference between the two framework. Then again, this may revert back, because with my reasonable assumption of 1% or 2%, if not in this year, next year I may get my things back. This year I did not get so much of returns, but next year I may get more returns. So things may revert back. So in those cases, I can still treat them as DTA or DTL, depending on whether I paid more tax than what my financial statement is saying versus paid less tax. If I paid more, it will be created as a DTA. If I paid less, it will be created as a DTL. So every year that's an accumulated figure again, because it is entered into the balance sheet either as a DTA or a DTL, depending on which is more. In this case, the DTA is more. Generally, the DTA only will be more, typically because depreciation, right? The depreciation wise, you will in the initial years, you are depreciating very heavily on the tax model and the tax reporting. So because you are depreciating very heavily initially, your profits are getting lesser. The tax you are paying is lesser. So initial periods, the DTL will get created. But over a period, your tax reporting, the depreciation is much lesser. So your tax will go much higher. Because your tax will go much higher, you are paying more than what your financial statement is saying. So as the company matures, there is a possibility of DTA being more. So as a net, you will see some kind of a DTA existing, and DTL will look blank. Right? So 3-4 areas are there which are the key areas where the financial reporting differs from tax reporting. And probably even allocations to pensions and all that stuff. They will reasonably assume, okay, I will pay 2% to contribute 12% to PF. So that is my expense. Tax reporting simply says, did you really contribute or not? Did you really put your money there? Right? In financial reporting, I will directly take it as an expense. So my profit may come down or go up. Whereas in tax reporting, did you really put or not? No assumptions. Did you really contribute to that or not? If you have really contributed, take it. Otherwise, pay the tax on this year. When you contribute next year, take the benefit. So there is a scope of revertibility. So tax reporting always believes on actual tasks, whereas financial reporting provides a lot of spaces where you can make reasonable assumptions and go forward in terms of your expenses or revenues, right? So that is one more area where there is a clear cut difference between tax reporting and financial reporting, and because of that the tax which you are really ending up paying is either more than what your financial statement is saying or less than what your financial statement is saying. So that difference gets created as a DTA or a DTL, right? They both net each other. They both net each other. So either in most of I mean in details you will see both of them. In the notes you will see both what are the total DTAs and what are the total DTLs. And one more area for a DTA probably is carried forward tax losses. If a company for the last 2 years or 2-3 years they are in losses, right? For the last 2-3 years if they are into losses, one, they don't have any tax. Two, the tax is getting carried forward. So let's say last year 100 is the loss. Last 3 years, let's say the loss is 100, 100, 100. Logically, simply put, they have to pay 30% on it, which means minus 30 in the first year, minus 30 in the second year, minus 30 in the third year. Minus 90 is what they have to pay. Minus 90 paying is same as getting 90. So the government needs to pay them 90 for the losses which they have. So what typically happens is they have to start paying tax next year. Let's say even if they become profitable, they will pay the tax not on the first rupee which they get, only if their profit crosses 300 rupees, which is the covering of all the previous year's losses. Only when they cross the 300 rupees, then only they will start paying the tax. So because of that, this 90, 30, 30, 30 is created as a deferred tax asset. It's like you have paid in advance, or you have to get the benefit from the government. Logically speaking, right? You have to get the benefit from the government. So it's an asset. The asset that is created because of a deferred tax. So you will call it as a deferred tax asset itself, right? But again, there is a policy which says if you think that those you will never become profitable, then probably that has to be removed. If you think that in a reasonable time frame, in the next 1-2 years, I'll become profitable. Last 2-3 years have been loss years, but next 1-2 years I'll become profitable, right? And then I have to pay the tax. Then you can create, you can provide you can make a provision for the deferred tax in the financial statement, right? Even that is the place where a DTA can get created, especially for a company which is having consecutive years of losses and it is still hoping that profitability is very much possible. Probably if you look at the Kingfisher's financial statements, you will see that their deferred tax assets are more than any other asset, because they have been piling up losses for years and years. So all the tax which they have to pay, almost 4,000 crores is the deferred tax asset. Out of their total assets of around 8,000 crores, 4,000 odd crores is the deferred tax asset itself. Only when they make a profit of more than probably 12,000 crores or something, 30% of that around 4,000 crores, only when their profit crosses that number, then only they will have to pay a tax. So in these cases, you will not see that much big numbers at least. 200 crores out of again 7 to 8, 9, 10,000 crores total assets, which is a very small portion. But there it's almost 50%, because your losses have been piling up for years and years and years. Okay. Now the next part is in the share capital itself. you can have stock options. What are these stock options? The company gives an option to the employee. Option is actually, in true sense, it's a derivative instrument, right? But in a simplistic sense, it gives an option to an employee to buy the shares of the company. The company does not allocate shares to the employee. This is a very common wrong notion that is there with stock option. The company gives a share to the employee. That's not the case. Company gives an option to purchase the shares of the company at a predefined price. It will simply say, okay, next year, if you work with the company for 1 year or 2 years, they give different slabs. We'll give you, I'll take an example. We'll give you 100 shares of the company, or we are giving you 100 stock options. The company will tell to one of its senior employee, along with your salary, we'll give you 100 stock options. What do those 100 stock options tell? They'll say, we will have a 4-year vesting period, or simply put, 1/4 can be vested after 1 year, another 1/4 after 1 more year, another 1/4 after 1 more, another 1/4 after 1 more, which means 25 stock options you can use after 1 year of your service with the company, another 25 after 2 years, another 25 after 3 years, another 25 after 4 years. What do I mean by that using the stock option? I have the right, if I have taken the stock option, I have an option to buy the shares of a company, 25 shares of that company, at a predetermined price itself. The company sets the price on the day it has given me the stock option itself. The company will say, probably you can buy the share of the company at 2000 rupees. After 1 year, after 2 years, after 3 years, after 4 years. Whatever is the stock price on that day. If it is 1800 or 2200, whatever it is, I'll give you an option to buy the share of the company at 2000 only. Right? So what happens? 25 shares on this day, this guy can pay 2000 and purchase the 25 shares of the company. So almost 50,000 he is spending and purchase 25 shares of the company. But when will he do that? If the market price on that day is 2100, the share price on that day is 2100, he is still buying it at 2000 only. Probably that 100 rupees is his benefit, because he immediately sells them into the market. He will get 100 rupees. 100 rupees into 25 shares. So 2500 will be his benefit if he is selling it off on the spot. Right? So the benefit which the employee is getting is not 100 shares. Is only the 100 multiplied by that excess amount. That is the total benefit he is getting. One percent. See, that is not stock option. That's a stock allotment or stock grant. What that says is we'll directly give that is fixed as a part of the salary itself. Like let's say today the stock price is 2000, and let's say I want to give you 100 shares in the company. So which is equivalent to 2 lakhs. So I'll add this 2 lakhs as a part of your salary itself. So the 2 lakhs, so in your CTC, let's say if your CTC is 25 lakhs, I'll add this 2 and I'll say your CTC is 27. 2 lakhs will be in the form of 100 shares, and the remaining 25 lakhs is your package. So if you work well, obviously the stock price will go up and you can make a profit. Right? As we said, the company's performance is very much related to the stock price. So if the company, if the manager or senior guy contributes to the company's profitability, obviously the stock price will go up and his worth also will go up. But in most of the cases, the companies don't give stock grants, they give stock options only. Even in this case also, instead of giving 100 shares like this, because sometimes allotting a share may not be feasible for the company, especially because it may decrease the overall earnings per share of the company. So they may not be interested in doing the stock allocation on the spot itself. They generally prefer going with the options route only, because here they can give many options. After 1 year, I'll give you why only 100 options. I'll say I'll give you 10,000 options. There was a company which has allotted me 10,000 options on my joining. But the benefit which you will really get is only when the stock price crosses that amount, and the benefit is only that extra amount. Whereas in this case, if they are giving it for free, literally you look at it, even if the stock price goes to 1500, it's your benefit only, because you paid zero for it. Even right now it is 2000, even if it goes at 1500, it's a benefit for you. So there is no motivation for working extra. Probably you will say, okay, you work for 3 months, quit, sell off the shares, quit. You are getting your money. Whatever is the stock price there, you are getting it. So companies don't generally encourage that model, because the moment share comes into your account, company can't do anything in that. It's your personal. Whereas in this case, the company as a whole, the share will get transferred only if you buy it. And that too, after 1 year, they are giving that option. So 1 year you are working, then you are buying, right? Then only it is really getting vested. Otherwise it will lapse. If the market price on that day is 1900, you are simply lapsing it. Because obviously you will not buy it at 2000 unless you are really you really feel that in future it will go up to 25 or 26 or whatever. You will not buy it at 2000 when the market price is 1900. Probably you may think, why not buy it at 1900 from the market itself? If you really think that the stock will perform well, why to buy it from here at 2000? Why not buy it from the market, in the secondary market, at 1900 and keep it just like this? So no one will buy in this case. So in a way, here you are prompting the employee to increase the stock price. So it's a kind of motivation factor if I give it as an option. But if I give it as a stock grant, there is no motivation, because I am getting it for free anyhow. Any excess is my profit only. Probably they may club it as a part my CTC or whatever. At the end for me, okay, I'll think my CTC is only 25. Why 27? The company will club 100 different things as a part of CTC. To announce it somewhere else for my new job, I'll set 27 as my target. And I'll get a hike on the top of 27. But for my internal calculation, I'll take it as 25 only. Right? So there is no motivation for really getting more and more profits. Anything I get is a profit. So that may pull down the stock price of the company in a big way. So that's where companies don't encourage this process unless a very senior level guy or whatever. We don't know. But in general case, even for very senior guys today, they prefer giving stock options only. Because one, they can give many number. Because the additional cost for them is only the difference. The additional cost for the company is only the difference. Right? So it does not, even if you give 10,000 stock options, it's not going to cost for them too much. Right? So if at all this guy is using them and converting them into shares by buying it, that's where the new shares get issued. This new shares come into picture only in that case. These stock options, they get matured, and based on that the employee says we'll go for converting them into stocks. Stock option is converted into a stock by buying it on that date. So when the stock option is converted into a stock, then the share capital is going to increase. And sometimes the companies may increase the shares like this, and let's say, okay, 25 new shares are bought. When 25 new shares are bought, the EPS will go down because the profit is not changing, but number of shares are going up. The EPS will go down. And probably from an investment standpoint, it's not looked at as that much of a positive signal. So the company may even think of buy back 25 shares. This is also another place where they can think of buying back. Because they are issuing 25 new shares, better get back some 25 shares from the market. So that overall number of shares are not getting disturbed. The EPS does not get disturbed. There is also one more mechanism which the companies resort to. The buyback can happen even because of this reason. Stock options, I am giving it to some new employees and all. Once they are converting them into shares, the number of shares are going up. This will reduce a lot of other stuff. EPS and all that stuff will reduce. So the company will take enough care to make sure that the EPS does not go down. So they will try to buy back a similar number of shares so that overall number of shares which are there in the company is still maintained. Fine. So of course the how much it would cost for the company and all, they are actually done through various option pricing models. So in the derivatives world, there are different types of option pricing models. There is a binomial tree pricing model or a Black-Scholes pricing model. So using that different pricing models, the company will estimate what would be the cost for the company by granting this kind of option. Because see, the real benefit will come only when I look at the stock price on that day, 1 year later. But today I have to show something in my financial statement as some expense to the company. That expense calculation happens based on these kind of models. So whatever the numbers they calculate based on a Black-Scholes model or whatever it is, based on that they put it as an expense, and every year when this person converts them into shares, the share capital will increase, and probably by that extent the reserves also will increase because new shares are getting created. So corresponding to the new shares that are getting created, all the other stuff also, because he is paying not 1 rupee for that share, but probably he is paying some few hundred rupees for that share. So that few hundred rupees should increase the reserves also according. Right? So this is on these two key terms, because the buyback is also linked with the stock option.